Hey guys, and welcome back. We're covering another in-depth look here on Roy's investments about selling puts. So I talk a little bit on the podcast for you guys that I've been following it about making some puts, moving in puts. What am I talking about? What is buying a put and what is selling a put? What even is a put? Okay, so a put is a bet to like the downside. It is betting that it will be lower than something or will be above something at the end of a time period. So the ROI of a put is, if you're selling them, are directly able to be founded before you start into a put. It's similar to when an insurance company sells insurance, in the way that they charge you a premium every single month. And if something goes catastrophically wrong with where you are, then they come in and they give you that insurance. And so what you do by selling puts is you're the company selling the insurance. As long as nothing catastrophic happens in the stock price, then you are good to go. And so what that means is if it stays above a certain price the entire time or finishes above a certain price at the end of the time, you're going to make some money and you're going to get a guaranteed return on investment. It's a great way to accumulate a stock for a long term, and we'll talk to why that is in a little bit. And it's a solid way to make money in the short term because time is working in your favor. You make money passively here. So starting off, I want to look at an actual example that you'd see if you were trading on Robinhood. And so what you're betting on here is you're betting on the stock price here, the Workhorse. Okay, so each one of these each put is a bet on 100 shares. So if we did the math here, we could just take this decimal point and move it over 2 zeros. And you are betting $1,200 roughly based off of where you put it. If you did this one, then it would be $1,250, but just a little bit less because Robinhood will insure maybe 10 or 20 bucks of that for you to take it on, which is another reason to do it because Robinhood will pay for it a little bit up front. Your broker will take on a little bit of the risk. And if you were doing the 12, you'd be at around 1,200 of a risk. And this, you are using these amounts like 1,200, 1,250, and you're risking that to make $35, or if you're using the 12s, you're risking that to make $18. But this is guaranteed. This is you're not estimating what's going on. You're not wondering, will I have a return in the future? As long as it stays above this price, whatever price it may be, if you enter into this contract, then you will get this if it stays above 12.5 at the end of the day. If you enter into this one, then you will have $18 coming to you at the end of the day as long as it's above 12. And see, these are the ways that you're able to calculate out the return on investment right before you do it. If you were to do this one with the 12, you are risking $1,200 to make $18 guaranteed. That is a return on investment of 1.5%, which is pretty nice considering that we're only looking 1 week out here. These were a little bit from before, so you can see that we're doing them on July 16th, but you can do these every single week, July 16th, 23rd, 30th, August 6th, and then here on out. But, and in the order summary, you get to see that you are agreeing to buy 100 shares of Workhorse at $12 if it's below that on the agreed upon date, which is July 16th. If it is not below that at the end of July 16th, then you will keep the $18 credit, which is really nice. But let's cover what happens if, you lose. What if I sell a put, hold it till expiration, and it finishes in the money? Okay, what am I talking about? In the money. Well, there's a definition of that on the show and on the website, but in the money means it is finishing below the agreed upon price. So an in the money thing for this at the 12.5 would be 12.49, 12.48, $12, $13, or $11, $10, $9, any one of them, as long as they are below this one. In the money for this one, for the $12 puts, that's $11.99, $11.80, $11, $9, anything below $12. And so that is in the money, which means that you are getting, what you are doing in a sense is you're getting paid this premium, and now you're getting allocated 100 shares of Workhorse. So what happens and how does it go? And I'm going to walk you through an example here of what would happen. So an example, if I sold two of the $12 Workhorse puts, and the price finishes at $11.40 at expiration, and the premium is $18, which is from here, $12 puts, $18 premiums, then what happens at the end? Okay, so the position that you start off with, if you hold through the expiration date and it finishes in the money, is you have the initial loss, which is $11.40, which is where the price is. This is all hypothetical, but the $11.40, which is what we're saying the hypothetical finishing price of it is, minus $12, which is where you agreed to buy the puts on, times 100. But you're getting that plus $18 because they're paying you up front to take on the risk. And then you multiply that by 2 because we sold 2 of these Workhorse puts. So the math here is this minus this times 100 and then times 2 is going to get you negative 120 plus 36. And to start out, you are down $84. But is that necessarily a bad thing? I mean, it might look bad on paper, but what the great thing about it is now you're a shareholder. Also, you didn't get all 84 of the loss because TD Ameritrade, Robinhood, whoever covers a part of that loss. So you're probably down like $80 or $76, something like that. But you get this. What they're doing in a sense is if you like the company and you wanted to own shares on it and you think it's a good buy at where it is, sell some puts on it. Because if it gets below that price, then you are now a shareholder and somebody paid you to be a shareholder. Like, what a steal. And Robinhood or TD Ameritrade, whoever you're like trading on, they cover part of the risk as well. So you're getting it for a deal and somebody's paying you to do it. This is great. Okay, so that's like one of the best case scenarios. Another great scenario would be if you sold it and it stays above that. Then you just get the premium itself, which would just be the $36 if you hold till expiration. But I want to cover what happens if I sell a put and the stock price drops a lot. Your position will decrease, but it's not realized yet. And there's always an option until expiration date to buy out of your position. And so what that means is that these contracts are a done deal, but if you want to buy it back, you can buy it back for whatever the premium amount is at that price. I recommend kind of trying to hold through that unless it's an absolute whacking of something or you see some dramatic news changes. But if you hold on to it and it's not realized yet, which means you don't buy it back, and the price bounces back before expiration, there's a chance you will recover that loss. I guess another great question is, what happens if I sell a put and the stock price increases? Well, you got nothing to be worried about. You just get the money that you got for the premiums, and then that's gonna be like an almost done deal thing, and the money's gonna be ticking towards you as the position rolls on. So if you started at the $18 ones right here with the $12 puts and you got $18, and then the next day you see the price of Workhorse takes off to the upside and is now at $14, then the price of this, the premium amount, will go down. The reason for that is that time is working on your side, and you want this price, the premium price here, to go to 0. That's how you make money. So as this goes down, the money that it's going down by, like if it drops from 18 to 17, then you just made $1. If it goes from 18 to 20, you just lost $2 per the amount of contracts that you picked up. So you want it to tick down. So what I'm talking about is it comes to you gradually. And if it ticks up to $14, I'd guess that it would kind of shoot back down. It would go down to like 10 or 12, somewhere around that. And you just made roughly $8 or $6 per the amount of contracts that you had on this. One thing that I like to do if that ends up going on is I like to roll up, which means that if it just went from $12 to $14 and it has momentum, you don't need to sit there and wait for expiration until you get out. you can roll it up, which means that you can move it up from, you could buy out of the position you had at 12 and then roll it up, maybe the 12.5s if you're feeling risky. And if you're really feeling risky, maybe the 13s or the 13.5s, because the premiums up there are still worthwhile, because they're going to be higher because like the price just shot up, which means that there's, in the investors' minds, there's a chance that it shoots right back down. So there's like a chance of that. So those are going to decrease, but they're going to still have better worth than what your thing was at the bottom if you held the 12s, which are probably going to go from 18 to like 10, maybe $9. Who knows? The ones that looking at here, these are going to decrease, but you can see that these decrease in relativity to where the price is. Okay, so you see how these decreased 16.22 that day. That's because like the price looked like it was going to be stable and not go down, because it's like a bet. If the price isn't going to go to like the absolute floor, then these aren't necessary. So these are going to be worth less. People are willing to pay less to get these because you don't need that kind of insurance. Like if you lived in Florida, you'd want hurricane insurance, right? But if you found out that there is like not going to be any hurricanes that year, then you're gonna probably want to pay less for that, because there's no need to have that. There's no hurricanes on the horizon, and you're good to go. And that's where, when you're selling puts, you become like somewhat of an insurance company selling insurance for these investors. Another one is, what happens if I sell a put, hold it till expiration, and finishes out of money? How much money did I win? All right, I talked a little bit about this, but it's just going to be the premium received times the number of contracts. So we walked it through, and then we got to, because we know at this point that the contracts for these are worth $18 at the $12 premium, or the premium here is 18 and the contracts here are at 12. So we already know that it's just going to be the premium received. We talked about that a little bit. But you just received the premium if you held it till expiration, if it finishes above 12, which is good. $36, that's coming your way, and that's guaranteed. That's why selling puts is such a great way to make constant money in this market. You don't need the price of the stock to go up. You just need it to not go down. And that's where the real power of these are. I mean, what we're doing is I'm telling you that we can do something where we make 1.5% return on investment maybe in a week. Fantastic. If you do that for 52 weeks, you just made like something around like 80% return on the year, which is fantastic. We're not hitting home runs here. Okay? And then how far out can I enter into a position? That's what these are. The July 16th, July 23rd, July 30th, August 6th, August 13th. These go on an infinite amount. Of course, as you go out further and further, these are going to go up. Instead of at this week, at the $12, the next week one, the people are paying for more time in the future because they're uncertain about it. So maybe instead of at the $12 puts, how they're worth 18, maybe in the future they're worth 40, because they need to buy and entice people to like want to sell that as well. That's how they do it. You have to pay more if you're buying a put for the time in the future. If you're selling a put, then you're getting more money for it in the future. But that's because the price is volatile. It can go up, it can go down. We don't really know what it's going to do in the short term, or we don't really know what it's going to do in the long term. That's why if you take on something like the end of the year December puts, they're going to be sky high for a $12 put, because the price of this stock, because it's volatile, could be at like 4, could be at 100. We don't really know. That's why I like to take them on a 1 to 2 week basis, and I think I talk about that a little bit here. And most of the big stocks that you can trade these on probably run out in like to a 1 or 2 year time frame. I don't really do that. I rarely enter into a position that's more than a month or two into the future, because stocks are hard to predict that far out, as we just covered. But these are very good strategies for you guys to go on and make a little bit more money, and on your trades be a little bit more consistent as well. One thing else that I kind of didn't label on here, but I'd really want to talk about is, yes, if you're a believer of the stock being worth more in the future, you can. There is no reason that you can't enter into a $13 put or a $13.5 put. But at that point, you just gotta weigh like how much it's gonna actually move up at that point. And if you're wrong and it moves to the downside, these can really bleed you out pretty quickly. But the good thing for you is they can only bleed you out a maximum amount of the amount of money that you're putting into them. If you sell one, your maximum risk is $1,200. If you did two, your maximum risk is $2,400. So the risk on these is finite because the stock can only go to zero. It can't go past that. If we're going to talk about selling calls in the future, I'll tell you why your risk is unlimited, but that should be quite obvious because if you sell a put, your risk is limited because it can only go to zero. Your risk is unlimited if you sell a call because that can go to infinity per se. All right. I appreciate you guys being here. Hope you guys learned a lot. If you guys have any questions about this stuff, let me know. We'll also be posting the slides up with these so that you guys can walk through them with me. If you guys have any questions about it, I'd love to talk more. I'm going to definitely be referring to these on the show, and I really hope that this makes you a good trader. Thanks for tuning in to Roy's In-Depth Look.